Welcome to Trading Group 2. Today is the 8th of May, 2018, so welcome everyone. Looks like we have a little bit of a quiet day in the market. It's down about 5 points. Not too bad. Cover calls are doing okay.
Isn't Trump supposed to make some announcement this afternoon?
Yeah, about the Iran deal or something.
So it could be kind of like a Fed day where things are quiet until he opens his mouth.
Yeah, it could be. I did see something that there's a large impact expected on oil if the U.S. pulls out of that deal. Which would obviously affect other things too. But so, how are you doing, Andrew? Are you have any positions on these days, or are you still flat?
Now I have nothing on. I was trading straddles, actually day trading straddles back in March, and it was working really well because there were a lot of big trend days.
Right.
But then in April that stopped working. We started having more trading range days. So the last few weeks I've just been relaxing and doing nothing. I'm actually looking to get back into the market. Um, I missed a great bearish butterfly trade last month. I tried to get too cute and I didn't want to pay up and I missed the trade. So now I think what makes sense is a road trip type trade, but I'd like to do it on a day where volatility is up a little.
Yeah. Let's see, where are we at with vol right now? Looks like the VIX is at 15-ish, 1511. Still not bad. It's kind of in the sweet spot for volatility. No, it's not like 10 or anything.
Yeah, I think, it's kind of a sweet spot, volatility wise, where it's high enough that there's some fat in the options, but not so high that you got to worry about the market running away from you.
So, did you um, attend Leslie's technical analysis trading group meeting this weekend?
No, Sunday is just not a good time. When he was doing them on Saturdays, it was okay, but Sunday is just not a good time for me anyway.
I think he said he had to grade some exams for that um, charter technician um, it, thing that people take. He's on the board. So I think he said he was grading exams either last weekend, this weekend, or this weekend and next weekend.
Yeah, that's supposed to be a really tough exam, isn't it?
That's what I heard. I've never taken it or looked into it, but I heard it's not easy.
Yeah, a lot of I think a lot of material to learn. I
That's
mean, it's
true.
it's really like a college level course.
Hey, Wayne, I see your screen. Did you want to show us something?
Hey, Tom, this is Tim Broff.
Hey, Tim.
Good morning.
Good. How are
Um,
you?
I'm good. Just curious if any of the attendees here have ever gone to Shivaco Capital Management. Um, he does a weekly update, a technical analysis of the market. He takes more of I would say, 100-foot view, and he does a really good job of putting current market conditions into perspective, uh, what past markets have done and everything. It's just a short bit, probably 15 or 20 minutes. He does it every Saturday.
Oh, I haven't seen that.
No?
Do you have the URL or the address?
Yes, I do. Let me grab it here real quick. Um, Actually, if you just go in, Okay. I'll,
Or if there's some place on the website you could point us to.
well, somehow I lost your page here. On the, I'm on a new PC and it keeps flipping from your screen to launching the Zoom. Not sure what happened here. Well, I think we're going to have to log out and log back in.
Okay, sorry, my wife called, so I didn't want to go over the recording with that kind of stuff. So Tim, you don't have the address or
Yes, I do, but I lost your screen and chat window, so I'm going to have to log back in here.
Oh, okay.
Um,
Or maybe if you could read it, maybe we could just
okay. If you go to YouTube, that's where he posts it.
okay.
Just type in CIOVACCO capital.
Okay, I see it. There's a channel. So looks like this might be it. Got 12,000 subscribers. So we posted one 3 days ago, volatile market, trees hiding, bullish forest. Does that sound right?
Yeah, because that usually he posted either late Friday or early Saturday morning.
Okay. So it sounds like just from the title, he's got a bullish outlook on the market.
Yeah, he is long-term bullish right now.
Yeah, Adam Grimes kind of has a similar idea. He's not sure if the market's short-term going to be moving higher or lower, but he's looking at weekly and monthly charts and definitely a bull flag. So he's thinking longer-term bullish, shorter-term could go either way.
Yeah, that's kind of the feeling that Shivako has also. And in general, he takes a longer-term view of the market. He's put in a really complex model together for how he trades. I should say how he invests. He's not really a trader.
Right.
He runs capital for long-term investors.
Nothing wrong with that. So how's everyone's trades doing? I guess I can update a couple of my road trips if people want to see them. Let's see, option view. Get that black bar out of the way. So let me know when you can see the screen.
Yep, we see it.
All right, let's see. So here's my 31 May position. This one's looking okay. Should make over 1,000. Already up 1,200. This area is up 1,500. I'm also the kind of the opinion that we're probably not going to go down too much, but still kind of longer term bullish, at least for well, maybe even shorter term. Market's been pretty strong. I added a couple of calls to some of the positions the other day. So again, if the market does start rising, I want to take advantage of that a little bit. And 29 June's got the same idea. And the 20 July, it's a IB broker quotes here. I didn't put the calls on this one. I did more of a Dan's butterfly hedge kind of thing. So I remember Charles Cottle had a thing a long time ago. He said you should have 10 positions, 3 leaning long, 3 leaning short, 3 neutral, and 1 spec. So I didn't want all my trades to lean long, so I had this one in July is more neutral. But at this P&L at expiration is already at 800, so it's kind of like a combination road trip weirdo, I guess, if you look at it. But it's pretty easy to manage.
Looks good.
Yeah, I think I like blue. I don't know why option of you can't let me have blue all the time. But anyway, be that as it may, yeah, it's has some good potential. I think Dan's positions are doing pretty well. He's in the catbird seat on this 31 May position, up about $2,000. He's scaled it back quite a bit. He's just doing. Calls it Delta Patrol at this point. He's just keeping up with the Delta changes and trying to keep decent theta. I'm not sure exactly what he's trying to get out of it, but he's up around 10%, so that's a good trade. His 15 June is looking good too. That's up about 1,800. And his 29 June has that butterfly hedge kind of look. He hasn't lifted this up much, but if you go out to what, T38? My favorite airplane, by the way. T38 was great. That's what it looks like. And then his 20 June also has that butterfly hedge kind of shape and $500 above zero at this line. So nice looking trades. Let's see, there's a couple things in the chat. I can figure out where it is on my screen. Okay. How do you refresh to change option view color? Oh, well, you just have to keep hitting the Analyze tab. There's 4 colors that they use. If you go to Settings, I think you can change them. Let's see, where's the colors? Oh, there it is. So there's a couple colors here. I've never actually tried to change them. Maybe, I don't even know. I don't think you can delete them though. But whatever you have here, just hit the Analyze tab. It just cycles through them. So you got kind of red, green, what is that, pink, and blue. So I always just keep hitting Analyze until I get the color I want. Any presentation on the upper Brooklyn butterfly hedge? Not yet. Dan has a PowerPoint. We just haven't scheduled the webinar to present it. Basically, what he does is he goes more than 45 days out, and he goes about 100 points above the market, maybe 120. Just looking for like a 25-point strike because these are farther out, so he wants good liquidity. And then he'll sell a couple. Let's see, where are they? So here he sold I guess he did it on the 2760 strike. So he normally goes 25 points. So yep, there's your 25 points below and 50 points above, and that's exactly what he did. So if I could just look at that by itself, let's see, July 20th. I just put some R codes in here, then I can break the trade up and just look at the hedge by itself. So that's the hedge by itself. Today it's down a little bit, but it's pretty easy to manage. I think his management technique is something like it gets around here, then he'll roll the butterfly down or out, or just take it off. Maybe he did one where he converted it to a credit spread. I think it was on June 29th, maybe. No, maybe June 15th. Yeah, this is one. So his butterfly hedge was taking a little heat, so he took it off and just put a call credit spread on to replace it. So he's pretty flexible with it. Yes, so typically with the road trip, what he'll do now is he'll put it on for a slight credit, because when he puts the butterfly hedge on, that'll balance it out. So like if you go back to the 20 July position and you just look at the core road trip, This is actually just slightly above zero. Can't remember if he's adjusted this or not. I don't think so. 20 July. No, he hasn't. So this is still the original trade that he put on. So it was about 18,000 in margin without the butterfly hedge and plus 70. And then if you just do the butterfly hedge, that adds, this 472, and then over this. So then combine them. Let's see, combine. And then it looks like this, and now your margin is down a little bit, like about $350 it takes off because the butterfly hedge has no risk to the downside. But if you look at the theta or the Greeks before and after, so here's the Greeks without the butterfly hedge, so plus 1 delta, 1.3. And with the butterfly hedge, it's actually slightly negative. And the theta obviously goes up. SPX up, oil down. Could be the Trump news. I know the oil market's nervous about what's going to go on there. Let's see what's SPX doing anyway. It's up. Oh, it's up 1.5. So that's not too bad. But I like the butterfly hedge in general. It's nice. Dan's also doing weird ores, so you could probably even overlay a weird ore on top of a road trip. You probably have to watch out for stepping on strikes though. But do you put the up marker moves up at the beginning? Well, Dan puts the butterfly hedge on initially when he opens the trade. And I like to wait if I can, if we have a little bit of an up move, to put it on. Yeah, option view does tell you the days in trade. So like here, there's 73 days to expiration. And you can see over here, 73 days to expiration. And then the T plus 38 line is about halfway, I guess. And you can right click on it and change it. And you can type in like a T, 58, for instance, if you want 15 days expiration. And you can see 20 minus 5 is 15, so that's right. So here's what your 15 DTE line would look like. But you can control all those. You can even, you don't even have to use expiration if you want, like T58, say T58 and T29, something like that. So now you're looking at the expiration line, or the 15 DTE line, and then halfway to that 15 DTE line. Please show the strike selection of the OV. Not sure what that question is. Strike selection.
Option view.
The strike selection. You mean for the butterfly hedge? Well, I think when Dan put this on, the market was a little bit lower, but I think he normally looks to put it on around 100 points above the market when he puts it on. Oh, option view define. Okay, strike selection. Okay, so here we're using auto strikes. For the ES, I generally don't use auto strike. I just manually put them in here, and then I control all these expirations. That's kind of a challenge sometimes. You have to figure out or guess sometimes if you use nothing or a W or an M or a Q. Option view can be a little finicky sometimes. And yeah, you can use the auto strike if you like. Again, I use it for the SPX. I'm just putting Dan's trades in for the class. But that's what we use for the option view stuff here. You need to look at the trade log to see days in trade. Oh, you're looking for days in trade. Yeah, you'd have to look in the T log. So you just pull up a trade like Dan's, say May 31st, and just go to the beginning, and you put that on March 14th.
Hey,
Oh, we
Tom.
do? Yep.
Somebody just recently pointed out to me in the beginner group there is a way to see it. If you go to status or reports, either one.
Oh, right.
You can put a column in there for it. Change the columns, and it's called
Days in position,
Yeah,
probably.
yeah.
Yep. There it
I didn't know
is.
that either. Someone pointed that out to me. So
Yeah, I've never actually tried changing these, so that's kind of neat. You can like, right-click on it and pick a, whatever they have here. So that's kind of nice.
Tom, supposedly the latest version of Option View improves how it handles the ES weekly options. I haven't
Oh,
had a
okay.
chance to play around with it, but
All right. Well, that's good because I use them all the time. I haven't really noticed any big changes, but
are you on 841?
I think I'm on the latest one. Let's see, yeah, 841. So I've got this new variable model. It's, I guess, working okay. Sometimes at the end of the day, none of them work, and the EIOIO is actually the closest to what I think reality is. But most of the time, this new model seems okay for me.
I know John Locke in his S&P 500 trades, he's using the EIOIO model in Option View.
Okay. I don't have a opinion either way, as long as it looks reasonable to me. Got my soda covered calls looking pretty good. I actually added an extra 10% of shares, so the risk graph looks like this. Your typical covered call would look more like this, where it's just flat. But I like soda, and I think the market's kind of bullish overall. And I wanted to accumulate the stock a little bit, after the call goes away. So I wanted to get a couple extra shares. So this is how the risk graph looks with the extra 10. And if you haven't played around with cover calls with adapting the number of shares, you can actually rotate this however you like. You might have limits in an IRA. So if you have like a cover call, let me just put a new trade on, different stock. Let's pick like spiders or something. So if you're neutral, just buy 100 shares and then sell something. As soon as I get data, maybe I'll just do back trade here. That's pretty fast. Oh wait, it's coming up. Oops, I didn't buy the stock. That's fine. Okay, so there's like your typical cover call. But if you want to rotate this either way, you could either buy more or less shares. So if you're not quite as bullish, you could do something like this. And if you compare them, you see the axis of rotations right at the current price. And if you want more, say you're really bullish on it, you do this. So it depends on how much rotation you want. But I just wanted a little bit. So if that stock kept going higher, I wanted to make a little bit more, but not crazy. And you see, it doesn't really change the break even too much, the expiration break even. Obviously, the more long stock you have, then that rotates it this way, which makes your expiration break even a little bit closer. But it generally doesn't change it too much. But I like having the extra long stock. See, Bruce, any recommendations on reading and cover call strategies? I know Jim taught a class on cover calls a couple of years ago. I know the CBOE had a cover call index, and he had some reading. I'll have to look it up. See, it was, it's 3 years old by now, but it's still a pretty good strategy.
Tim does the covered call every week in his beginners trading group.
Well,
Matter
maybe
of
Tim
fact,
ought to share some thoughts.
yeah.
okay. Well, yeah, I have I don't know 4 or 5 covered calls on, and I've been going over them in the group.
You mind going over them here?
I can, yeah.
All right.
See, screen, there it is. Um,
There we go.
got it. Okay. So now I need to call up this. Oops, can't call it up that way. Okay. I mean, I could spend hours doing this, but I'll just show you what I got. Here, this one. Okay. I have a little spreadsheet that I track them all in, and I have another little spreadsheet where you can do some analysis in. But basically, there's two goals. You need to know what you're after. Are you after having the shares and never getting rid of them and collecting dividends and stuff, or are you after simply covered call income and you don't care if you keep the shares or not? Some of these strategies are one of those and some of these are the other one, but this one has been a good one. So on Altria Group, I bought the shares for 60.06. It's now down to about 55, but I had sold this covered call. A little bit later, I bought it back for 14 cents, and I sold the another one further out in time, a month, for 43 cents. So if you add all that up, I've gotten $1,000 in option income in this trade since March 23rd. And you got to remember that does not take into account the current price of the stock, and it's gone down about 55. So I'd have about a $5 loss on 400 shares. So I'd be down about 1,000 if I actually close out this right now. But these are shares I want to own forever, collect the dividends, and so I'm not worried. And if necessary, I'll buy more shares and average down my price. So
Yeah, you can also sell puts to, to buy the stock.
Yes, and that gets into a slightly different strategy of combining cash secured puts with covered calls. That can be a very profitable strategy, and I've gone over that in the group too sometimes. But I think everybody probably wants to see something, so let's see. I think I have some of those modeled. I don't model all these in Thinkorswim because I don't look at them very often. Oh, here we are. There's that one. Here we are. Here's this one on Dominion. So here's Dominion. I bought 100 shares on March 26th. Same day I sold the 18 May 67.50 call. So right away you can see I got $238 in option premium, and if I get called away, I'll lose about 49 cents on the stock, which is $49. So if I get called away, this is a free and clear trade, you might say. This has been a good trade. Well, if we go look at the Dominion right now, if it ever updates, sometimes this has been getting pretty slow lately.
Looks like it thinks you're editing that symbol.
Yeah, it probably does. Let's try. Well, we'll just do it the hard way. Okay. Now, what do we have? It's updating, I guess. Should be updating. There it goes. So this is what it looks like. Dominion's at 64 or something now. It's gone down a little bit. Okay, I haven't checked for a week. So the graph isn't looking great, but again, if I'm willing to own the shares forever, this is not an issue. So right now it looks like these are going to expire, and then I'll just do it again. If you don't care if you own the shares for a long time or not, then I would probably have sold a little bit more in the money call at the time, taken maybe slightly less premium, but higher chance of losing the shares, but a higher chance of a smaller profit too. So I guess in the short review here, that's the two things I would say. Know what you're trying to do. Are you trying to acquire shares and keep them for a long time and collect dividends and dividend growth? Or are you trying to just do a covered call strategy and make some profit? And I do both.
So So I noticed you had not this one, the other stock that you had, that spreadsheet.
Oh, wait, sorry.
MO.
Yeah, MO, right. This one?
Yeah. So you basically rolled your 60 out. Is that do you roll down the calls ever, or do you always use the same strike?
Sometimes I do, but I don't want to here because I didn't want to have the possibility of getting assigned at less than my basis. You know, my basis is 60.06. I want to keep it at 60 for now. And I've been able to do that and still make decent premiums. So far on that one, we're good. Now, if we go look at MO and Thinkorswim, let's see, it's got to be in this list. There we go. That's not going to update either, okay. So right now my short call is the 15 June 60, and I sold it for 43 cents. If we look that up right now, it's 24 cents. So I could buy it back right now for a profit. Then I could stay either in June or go further out in time and get more premium. So for example, I could sell the 57.50, which is still out of the money right now because it's at 55. So I could buy it back for 24 and sell it for 65. I could get about 40 cents more credit without doing anything except watching my basis, which would now be under my basis on the stock. But if you take 1,063 and divide by 400, you get about 250. So I've essentially reduced my basis by about 250 by doing these options. So my real break even on this whole strategy is somewhere around 57.50. That means I could probably sell this one and take this profit and generate the income. So far, I've chosen not to do that, but I may. That would be a reasonable thing to do. And if I went out to July, or I wouldn't want to go to September. If I went to July, I can get even more premium, and that would probably make this trade profitable, even if I got assigned at 57.50. Does that make sense?
It does.
Yeah. Now, dividends. So the next dividend is approximately June 15th. That's another reason why I didn't go past June. I wanted to get that dividend. I mean, it's 70 cents. It's 280 bucks, you know, for 400 shares. I want that dividend. And so these June calls that I'm short, if they go in the money, I'm buying them back, and we're just going to wait till I get the dividend, and then we'll do it again. If they stay out of the money, then they'll just expire. And I usually track the dividend in here, and I guess I haven't had a dividend. Let's see, March. Yeah, it hasn't been a dividend since I opened this, but I do put the dividends in here, and that adds into this as well. So you have the whole picture. This little spreadsheet is really handy. It does lots of other things for me too, but this is how I track all the covered calls and most of the cash secured puts that I do. And lets me see at any time where my break even is and where my basis is and how I'm doing on the trade.
Yeah, I think the only problem with the cash secure puts is if somebody's in an IRA, their broker might not let them do that.
True, you have to watch that. That's true. I have one cash secured put on right now. I have two. Here's one of them on QCOM. April 27th. It hasn't been too long since I did this, but I sold the 50 for $1.94. And if you go look at QCOM now, just do it this way. QCOM. What month did I do? See, I can't remember. 15 June. Okay. I sold this put here for it's now about $1.25. I sold it for $1.94. So even if I should buy it back right now, I've got profit in this trade. But again, I wouldn't mind acquiring shares on this, so I'm going to make a campaign out of this and keep it going for a while and see what I can do with it. And then Duke is another one that's cash secured put. I started back in December. I've done some rolls, and Duke has gone down quite a bit. They went from 83.60 to 78, and so I kept rolling down just out of the money with these puts, and I've been able to garner about this much in options income on this. But probably roll it again. I'll just probably keep this one going too. But today Duke is down. Where's Duke? I think there's swim. There we are. Okay. Here's Duke. Will that update?
It looks like it thinks you're editing it again.
Yeah, I don't have the color chip set. Maybe that'll do it. There we go. So I'm short the 77.50 for 291, and it's currently at $1.45 or so. So if I bought that back, this lets me simulate that. Duke was at 78.50. I would buy to close, two of them. $1.45 would be the price, and there'd be some commission, so it'd be, we'll put in $6. So if that should happen, I'd have a net $142 loss on this stock right now. But Duke is one I wouldn't mind acquiring shares on either, so I'm going to just keep campaigning this and keep it going. This gets down to 20 or 30 or 40 cents, and it's still out of the money. I'll probably will buy it back and just sell a further out in time one. Further out in time, you know, has some pretty good premium. So, you know, if you really wanted to go to October, it has like $3. You know, that's all extrinsic value because these are out of the money. So,
So do you always go out the same distance, like 30, 45 days or farther, or does it depend on your goal for the position, like stock accumulation or just income?
it depends. For me, it depends more on the stock. I typically do low beta, high dividend paying stocks. You can see Duke's beta is 0.12. This is not a volatile stock, and it's got a pretty good dividend rate. Because of that, premiums are usually lower than they are if you take a stock like, I don't know, Tesla, you know?
Right.
So because of that, I do go out a little bit further on these kind of stocks than I would if I was doing a Tesla or something that's more volatile. But I try to stay within, for my first one, I try to be in about 30 days or so. With AT&T, it's so bad that I have to go about 60 days, but that's another stable stock. And then if I have to adjust, I'll do whatever it takes. I'll go out in time and down. I have been out as far as a year in some cases, but those were extreme cases. If I was doing Tesla, I would be looking at a week out or maybe 2 weeks out, at least to start.
Tim, how do you select your strikes for your short puts? Is it by delta or?
No. If I was, let's say we were doing a new one here on Duke, and by the way, Duke's a bad one to do because it has 2.5 point strikes. I mean, and then 5 point strikes. This is not good. I really would prefer to have had 1 point strikes for doing this, but it's what I did. And typically, you have to do the analysis, you know, and you have to make sure it meets your criteria, and you have to rank it against other possible ones, and that's a whole process that I'll go through sometimes. But you can also get a pretty close approximation by doing it in your head. If I want to have 12 to 20% annualized return for doing this, then, and I'm doing a 30-day one, then I need to have the premium be at least 1% of the strike price. Okay, so here, 85 cents is a little bit more than 1% of 77.50, which would be 77 cents. So this one would probably be a great one. This one would not. This is much less than 1%, so I wouldn't do it. And up here, now you're starting to get it to the in the money ones, and I'm typically not trying to be in the money when I'm selling cash secured puts, so I wouldn't be looking at any of these initially. Now that all, that's the quick and dirty thing I do in my head. It might turn out that this 80 strike was the best one. I'd have to do the further analysis, which is annualized return based on expiring and stuff like that. If I put in extrinsic here, yeah, that one has the highest extrinsic.
Yeah, they get the money will.
Yeah, it always will. I'm just going to say from guessing that this premium is not high enough to make it worth doing this, worth going into an in the money one if you did a new one right now. I bet you that this would be the strike right here if I did it. And that's not even 30 days out, so we really should be looking at, here's 38 days. Now you can see $1.40 is almost 20% of the premium, and sorry, 2%, which would be about 24% per year. This would probably be a great choice as well if you wanted to go out 38 days. Does that answer your question, Tom?
Yes, it did.
Yeah. There's always some subjectiveness to this. I mean, as to which strike to do, and there's always feelings. And so I always joke a little bit and say it depends on what I had for breakfast and how much coffee I've had and everything. And it really does. It makes a difference how you're feeling when you do this. You know, you're feeling kind of frisky, or are you feeling like you're tired and lazy and don't want to work very hard? That does make a difference.
Hey, Tim, this is Tom Henley. Flipping to the other side for covered calls.
Yeah.
I noticed you're looking at Duke right here, but we're talking about covered calls on dividend-paying stocks. Are you looking at the ex-dividend date to determine when you're going to purchase that to try and capture the dividend, as well as sell the call to bring in more income?
I do, but I'm not sure the way you said it is how I do it.
For instance, if I were going to purchase Duke for a covered call, knowing that the ex-dividend date is 5/17,
Yeah.
and today we're say 5/12, for instance, today is 5/8, I
Yeah.
would certainly want to get past that T+3, so I own the stock on the ex-dividend date.
Yes.
That way I'd receive the interest. Now, theoretically, of course, the stock price drops by the amount of the dividend, but it's not always the case. We know that. So
Yeah.
would that also be a determining factor on whether or not you entered the covered call on that date?
Yes, it is.
Okay.
Now, being this close, you know, what, 9 days? If I bought the stock today, I'd simply wait until I got the dividend, then I'd do the covered call, because you can't. There's no option that will expire before then. You know.
Yeah. Yep.
And so if you did even the 18 May, you're taking a chance of being assigned. If your goal is to not be assigned and keep the shares, then don't do it. Just wait till after the dividend happens.
Okay.
And then the next one will be, it's quarterly, so it'll be approximately August 17th. You could go clear out to July and have no risk of your option assigning you because of the dividend risk for being in the money.
Okay.
All right.
Good deal. Thank you.
Yeah. So yeah, that's a factor. If there's a couple months left, I do the same thing. Usually I'll try to find an option that expires just before the dividend, and then I don't worry about it. You know, Microsoft is a good example, I think. Let's look at Microsoft. So they have a dividend now. The next one's 16th. So that's in 7-8 days. But there's a 3-day option, right? So if you wanted to do it, you could get one covered call cycle in even before the dividend, even coming up this close. What would we do? It's at 95.67. This is all assuming that you did not want to lose the shares. You could think about one of these. You know, you aren't going to get 1% of the price, but this also is only 3 days instead of 30 days. So you really could handle 0.1% of the price and still get your 12 to 20% annualized return. And the shorter you can do it, the higher the annualized return will be, but the lower the dollars will be. So here, you know, maybe this one is reasonable, you know. go buy the stock and sell this option, get your $35, and then next week get your dividend, and then do it again. That would be a very good strategy to do, probably. I don't own Microsoft right now, and I don't care if I do. So I did do this one quite a bit in the past, but I haven't done it recently. So maybe I should look at it. But if you work it up in Thinkorswim, you know, here we are. You can just say you're going to buy a covered stock right here, and it is going to sell the 97 and buy the stock. And if you look at the risk graph, you can see that it looks like a standard covered call. And that's the other problem with doing these out of the money calls. Your break even to the downside is reduced versus doing in the money covered calls, because you're getting less dollars coming in from selling the options. So this break even is really close here. But if you're bullish on Microsoft or you like it, it could be a reasonable thing to do. Now there's another way you could do this. If you didn't care about owning shares, you could do a covered call. Let's do an in the money one. And to choose those, I would go over here and I look at extrinsic value, because you want to sell the highest extrinsic value. That's where your profit comes from. So I usually do a differential analysis, I call it, where I say between this strike and this strike is about 8 cents. Between that strike and the next strike is 9 cents. Between this strike and the next strike is 11 cents. And so I'm looking for what feels like the best differential price by going up in strike. And just off the top of my head right now, I'd probably pick this one here. So if you did that, you're getting 43 cents extrinsic value. You're going to get a sign for sure, because these are in the money unless the stock goes down. And if you look at the graph of this one, you get a bit lower break even, you know, from 95 to 95.70 to 94.6. So you've got about $1.60 downside protection on this trade, whereas the other one was much closer because it had less premium that you were selling. And this is one of the three ways of analyzing and ranking these, is what % downside premium protection do you have. If you took 95.66 and you subtract 94.08, you get a number. 95.66, 94.08. You get $1.58, and if you divide that by 95.67, that comes out to 1.6% downside protection. So this position protects you against a 1.6% drop in the stock. And so if you were to rank a whole bunch of these against each other, you might look for the one that has the highest downside protection if you want to be conservative in doing this. I like to look for 5% protection, but you don't always get that anymore, but you used to get it really easy. So as the strategist, you need to make your own decisions about what kind of downside protection you're looking for, what kind of % return, and what kind of dollar return you're looking for. And what are the results if the stock is unchanged? What are the results if it's assigned? And what are the results if it goes down, if the options expire? Those are the three main ways to do the analysis on this. I think I've fire hosed out a lot of stuff here really fast. Normally it would take longer to explain all these things, but kind of give you a picture of some of the things that I would look for and do when I do these.
And you see Bruce's question. He's wondering if there's any reading he could do other than, you know, the library that we've already got of videos.
Oh yeah, there is. The main recommendation I tell everybody to start with is Options as a Strategic Investment by Larry McMillan. I think he's up to the 4th or 5th edition now, and it's over 1,000 pages, and you don't need most of that, so you can get an older edition, and I think you can even get it from the library. But he's got a really good section on covered calls, and he outlines those three main ways of doing the analysis, and that's where I learned it. His first edition was written in 1983 or something.
I think I bought it in '82.
Yeah, I bought it in 87, and it was the first, that's what got me started in options, actually, was that book. And I think it all still applies, you know, the ways of doing the analysis. After that, there's some good websites, but there's some good stuff even in Thinkorswim about covered calls, and there's some good stuff on CBOE, educational section about covered calls. And I'll just show you one more thing here while I'm showing you things. Let's see. This one, I think it's this one. Oh, be slow, why don't you? Okay, let's see.
So I got a new computer last year.
Yeah, I'm gonna have to
I
replace.
got tired of waiting.
I know, I'm gonna have to replace one pretty soon myself. Okay, this is a little spreadsheet that I made that helps you do those three kinds of analysis I just mentioned: return if exercised, return if unchanged, downside protection percent, and this call efficiency is a little metric that I invented, but I like it. It's basically showing you, are you an options trader or a stock trader? You know, if you make your money on it, the lower this number is, the more you made off the stock and the less you made off the option. So if you want to be an options trader, and that's why we're doing this, you want a relatively high number here. So between these two examples, whatever I've got in here, this one made all its money off the stock, and this one actually made money off the option. So I can take another day and go through this, or I do it in the beginner group. You might be able to look those up, but this is, I still use this spreadsheet when I'm comparing. I'll work up two different stocks that are both at the money type covered calls, and I'll put in all the numbers, and then it'll calculate down here my annualized return if exercise, my annualized return if it's unchanged, and my downside protection percent. So you can see if I want high downside protection, then between these two, this is the better choice. Nucor. So I think I've talked a lot here. I think I'll defer. If we want to go over this, I can do it in another session, but
Yeah, it could be a whole thing by itself, right?
it could be a whole session, right? So I had a friend do some presentation stuff on here to make it easier to understand. So I had a friend help me out on this. So
It's a good looking spreadsheet.
yeah, and you could, actually, my friend who did this is now in the covered call service. So, so Tom, he's heading out to do covered calls.
Okay.
This is really handy. This is really helpful for me when I'm doing this.
Yeah, I like the cover calls. They're not as many moving parts as like a road trip.
Yeah, exactly. Right. So
See, Adrian had a question on the upper call butterflies. What credit do you try and get when done at Inception SPX? I think Dan doesn't like to do them below 45 days because he doesn't get enough credit. But I think generally he's getting anywhere from $2.50 to $4 credit. But that's just off the top of my head. I'd have to go look and see what he's actually been getting. And if he has any guidelines, I don't really know. I'd have to look at his PowerPoint again. It's been a while.
let's see.
How do I like trades on the non-equity underlyings? Well, oil's been interesting. I had kind of a net zero type of trade, and then it kind of moved around, and I morphed it. I think it's just slightly underwater on the current trade, but the first one made decent money, so I think overall it's up. The euro took a bit of a hit because the euro, I don't know if you've seen the current euro chart, but the dollar has been getting pretty strong, so the euro's been selling off. That one I think is underwater, but it still can make money. I did a few trades on the ZB. They look interesting. I'm not sure yet if I want to do a road trip on it, but and then my friend in Australia who with the Forex trading softwares, Bruno knows him, Daniel, he promised to get me something this week, Bruno. So promises, but that should be interesting if that actually shows up. Um,
I had a trade on oil until last night, and I decided to take it off because of the announcement today. But I like oil. I'm going to trade oil a little bit more here with just basically naked strangles, I think.
yeah, I see oil's down 1.5 today.
Hey,
Yeah.
Tom, have you looked at gold at all? It's been in kind of a wide trading range for a while. Seems like it would be good for a net zero type trade.
Yeah, I haven't looked at gold. I haven't looked at I'm sure the open interest is okay. Let me take a look. Gold, where are you? Here it is. Let's pop it in the back trader. Let's see, open interest. Yeah, it looks like on the May 25th expiration, most of the strikes at around the money are anywhere from 3 to 8,000 open interest. So yeah, there's definitely some volume there. I'll have to take a look. Have you traded gold before?
It's been a long time.
Yeah, it's like me with ZB. I don't know why I stopped
You know,
trading.
the thing that I like about it is I would assume that it's the same as crude oil. Somebody had asked Andrew Faldi about the fact that the volatility structure in commodities is different than it is in the index options. And his response was, since he was using deltas to place the options rather than prices, it kind of auto adjusted to whatever the skew is in the
Right.
market.
Yeah, makes sense. Certainly worth a look. Well, it looks like we're right at an hour, so this is probably a good time to stop. So thanks for the good discussion, Tim. Nice detailed look at cover calls. Like your spreadsheets. It might give me some ideas for building an online tool. Who knows? But yeah,
Yeah.
we'll see how the announcement goes, and we'll see everybody next week for Trading Group 2. So thanks everyone for joining, and we'll see you next time.